Under Nigerian tax law, investment income does not come from daily operations or active trading. It is the passive return derived from capital allocation, when your property, cash placements, or intellectual assets generate revenue without active labor. The statutes rigidly categorize these returns into 4 specific buckets: dividends, interest, rent, and royalties. Before calculating any tax liability, you must apply the temporal rule that governs all 4 categories, the preceding year basis. This rule dictates that assessable income for the current tax year, the year of assessment, is drawn exclusively from income accrued in the immediate past year. To calculate an exact tax liability, we cannot just look at a bank statement. We have to filter raw financial data through strict statutory boundaries to see what the state actually taxes. We will do this using 2 real-world case studies. We will now apply these statutory rules to specific financial data sets to demonstrate how the law transforms a raw gross receipt into chargeable income. Let's examine rental income through the Chukwuemeka case. He constructs a new 2-wing duplex and immediately collects 2 years of gross rent upfront from his new tenants. Under standard accounting, he has a massive cash influx today. But Nigerian tax law dictates that rental income is deemed to accrue to the recipient on a day-to-day basis over the specific period covered by the payment. Collecting a decade of advance rent creates a mathematical problem. The statute solves this with the 5-year rule. If advance rent exceeds 5 years, the excess time is visually severed. The tax assessment is forcefully compressed into exactly 5 years, regardless of lease length. By artificially bounding time, the Federal Inland Revenue Service prevents landlords from facing massive, unpayable upfront tax liabilities while actively blocking the use of long-term leases as vehicles for tax evasion. Once the timeline is set, we determine deductions. The prime directive here is absolute. An expense is only allowable if it was directly incurred for the purpose of earning that specific rental income. Looking at Chukwuemeka's ledger, we see gross rent against mixed expenses. We filter allowable expenses first. Water rates and agent commissions are necessary, so they are cleanly deducted. Capital expenditures like building depreciation are explicitly rejected. Personal appropriations like his private tenement rate are also discarded. Finally, we subtract agreed capital allowances, leaving the precise taxable figure, the chargeable rent. Notice that standard accounting profit does not apply here. The tax code actively rejects capital preservation metrics and personal drawings to isolate the true statutory yield of the property. Moving from physical property to corporate structures, we examine dividend income through the Nelson family. Their company, Nelson & Sons, generated 53 million naira in net profit, but has hoarded it for 8 years without paying a single dividend. This triggers the FIRS deemed dividend power. The tax authority intervenes when companies refuse to distribute profit to shield shareholders from income tax. The FIRS forcefully treats 15.9 million naira of retained profit as distributed. This is mathematically allocated to the 4 family members based strictly on their individual share capital ratios. This statutory mechanism actively pierces the corporate veil, proving that business owners cannot use a corporate entity as an infinite tax-free vault for personal wealth. While the FIRS aggressively targets profit hoarding, it must solve the inverse problem, the threat of double taxation when a company pays a legitimate dividend to another holding company. This is solved through franked investment income, a dividend received only after withholding tax is fully deducted at the source. This franked shield permanently excludes the dividend from the receiving company's total profits. Furthermore, the company can set off that initial withholding tax against any future redistributed dividends. So, while the FIRS forces distributions to prevent evasion, it simultaneously maintains the franked investment loop to ensure corporate dividends are taxed exactly once. The final layer of the statute defines cross-border investment income, specifically royalties and foreign interest flowing back into Nigeria. For these foreign incomes to be exempt from tax, they must satisfy a rigid dual condition rule. The funds must be repatriated in convertible currency, and they must land directly in a government-approved domiciliary account. The code also contains narrow domestic exemptions, like interest on agricultural loans. These only apply if strict moratorium limits of at least 12 months are maintained, and the interest rate does not exceed the base lending rate. If we pull all these case studies together, we arrive at the master formula. You take your gross receipt, subtract the impact of statutory spreads and disallowable expenses, and you arrive at your assessable income. The Nigerian tax system operates through these specific structural borders, capping time, forcing distributions, and blocking deductions to isolate the true statutory yield of an investment. Successfully navigating the system depends on identifying exactly when the law will apply these caps, force a distribution, or grant a shield.